good day. The world economy is experiencing extreme levels of uncertainty. Trade tensions have escalated, and long-standing geopolitical relationships are shifting abruptly. In these circumstances, the global economic outlook is unpredictable. Germany has set out plans for large investments in security and infrastructure, which are likely to lift European growth. Meanwhile, China has announced new stimulus measures to bolster demand. In the United States, economic sentiment is volatile. The year started with surging stock prices and a stronger dollar. More recently, however, the disruptive effects of tariffs and policy uncertainty have come into focus. Growth expectations have now slipped. The US dollar has weakened, and US stock markets have given up recent gains. By contrast, asset prices in other economies have been resilient, with most major currencies strengthening against the dollar. Inflation in advanced economies remains elevated, with both headline and core inflation above 2% in the United States, the Euro area, the United Kingdom, and even Japan. Some policy adjustments by major central banks are still expected this year, but rates are likely to remain high for longer given new inflation risks. Turning to South Africa, growth picked up in the fourth quarter of last year. As expected, the uptick was led by the household sector, boosted by lower inflation and withdrawals from the two-pot pension system. That said, the overall growth picture was disappointing, with other sectors showing weakness. Growth for 2025 was 0.6%, marginally below our expectations and slightly worse than in 2023. We have now revised down our 2025 growth forecast slightly to 1.7% while leaving the outer years unchanged. We attribute lower growth partly to subdued demand and partly to lingering supply fragilities. We assess that the risks to growth are to the downside. Moving to prices, while inflation is still in the bottom half of our target range, it has edged higher over the past few months. We continue to see low inflation for goods, which is likely to be temporary. Services inflation is somewhat higher, but still below the 4.5% target midpoint. Inflation expectations are close to the midpoint. For now, inflation appears contained. In terms of the outlook, the current forecast had more moving parts than usual, including a reweighting of the Consumer Price Index by Statistics South Africa and the proposed value-added tax increases announced in the budget. We have also adjusted assumptions such as the oil price to reflect shifts in global markets. The overall result of these changes is a marginally lower inflation outlook, with headline now projected at 3.6% this year and 4.5% next year. This is mainly due to the better fuel price projections. It also reflects a more benign path for administered prices, given the lower electricity tariffs announced by NERSA in February. These factors offset pressure from the proposed VAT increases, which we think will add about 0.2 percentage points to headline inflation. We see risks to this forecast on both the upside and the downside, with the balance of risks in the medium term skewed to the upside. Against this backdrop, the MPC decided to keep the policy rate unchanged at 7.5%. 4 members preferred this action, while 2 favored a cut of 25 basis points. For several quarters, we have enjoyed rising confidence in South Africa, with a smaller country risk premium and lower bond yields. However, the global economy is not on a stable footing, and there are also domestic uncertainties which put these favorable trends at risk. This calls for a cautious approach to policy. As before, the forecast sees rates stabilizing at a neutral level of about 7.25%. This rate path from the quarterly projection model remains a broad policy guide. The MPC would like to emphasize that its decisions will be made on a meeting-by-meeting basis and will continue to be outlook-dependent, responsive to data developments, and sensitive to the balance of risks to the forecast. Given the uncertain global situation, the MPC spent some time during this meeting exploring different external scenarios. For one, we considered a slowdown in the US with a weaker dollar and higher commodity prices, especially for gold. This implied some modest benefits for the South African economy, given better terms of trade and a stronger rand. Both inflation and the policy rate were therefore a little lower relative to the baseline forecast. We also explored scenarios we built around changes in South Africa's access to markets in the US. If South Africa were to lose AGOA benefits, we see some weakening of exports and slightly lower growth. If that were compounded with tariffs on South African exports, the effects would be larger. The most severe scenario we considered added a sentiment shock with a weaker rand, higher domestic inflation, and therefore a tighter policy stance. In this case, growth would be lower by 0.7 percentage points, with the exchange rate depreciation offsetting some of the tariff effects on exports. In a difficult global environment, it is vital to sustain domestic reforms that boost growth while preserving macroeconomic stability. The MPC's main contribution is to deliver low and stable inflation with well-anchored inflation expectations. The committee remains vigilant and ready to adjust policy as needed. Additional measures that would improve economic conditions include reaching a prudent public debt level, further repairing and strengthening network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains. This concludes the MPC statement, and at this stage we would invite you to pose questions, and the panel here will respond to your questions. As usual, please identify yourself and the media house that you represent. Kopan.
Good afternoon, Governor and Deputy Governors. Kopan Ogumbi from Reuters. Let me start here. Is it fair to say that global factors overweighted the decision for you guys to hold versus how the domestic environment is performing? Secondly, why attach so much weight to risks that have not directly impacted South Africa's economy yet? As you say, inflation is contained, the rand is holding steady, and the VAT increase will be balanced. So why not cut and use, the global environment as the reason to keep holding? Then, when you say inflation risks are to the upside and downside, does this mean the MPC views inflation as balanced in the short term? Or does this mean the committee was split down the middle on inflation, on if inflation risks are upside or downside? I'm not sure I've heard the committee use this language before, that it's either upside or downside. It's usually balanced down or up. So just some clarity on that. And then lastly, what would give you certainty that inflation is well contained? Because as you say in the statement, for now, what would give you that certainty? Thank you.
Kopano, your question about risks, you said that why give to risks that are what? The risks that have not yet materialized. Okay. Any other? In the room? Alistair.
Alistair Ball from Bloomberg. Thanks very much for taking our questions, Governor. I'd like to ask you a little bit about the risks around the out-year inflation forecast. Inflation came in softer than anticipated for this year. How would you sort of describe your confidence levels around your out-year inflation forecasts, given the 26 and 27,
yeah.
given the uncertainties? Could you have a better outcome? Thank you.
Okay, online.
Yes, Governor, we have a question from Palesa Mofokeng at CNBC Africa. As China is a key trading partner for South Africa, to what extent has deflation in China helped contain local inflation?
Is that it?
That's it, yes.
Okay. Fundi, you are going to deal with Kopano's question about inflation upside, downside, medium term upside. I think you might be having a better command of the Queen's language than I do, so I will leave that. I will leave that with you. So you prepare. And Rashad, you spend a lot of time with these chaps in international fora. So the deflation about China is going to be yours. And okay. Chris Lovald, what gives you so much confidence about your forecasts for the outer years, 2026, 2027? That's you. Kopano, as my kids would always say, it is unfair. And you asked me, is it fair? So my temptation would be that it is unfair. Now, it is rather incorrect to say that you have given more weight to global factors than to domestic factors, and this is how we think about it. The point of departure in analyzing any small open economy like South Africa is what the state of the global economy is. And as we had stated, in this meeting and in dealing with the forecast, there had been so many moving parts than we had to deal with before. Globally, we do not know where policy would end up. There are pronouncements across the Atlantic on both sides, and that becomes difficult to forecast. And those pronouncements come and they change so frequently that it is difficult for anybody to say, this is where I think it is going. Bear in mind that developments in the global economy link directly into our own economic developments and also indirectly. So it depends on the channel. And as the question came from Palesa that said, to what extent deflation in China would have impacted on inflation in South Africa, I guess you get the picture that if you are a small open economy, global developments impact on how your own economic outlook evolves. And that is what you are actually faced with. You can't disentangle and say it's now all about domestic or it's all about domestic, because the two are interlinked. Domestic developments impact on domestic economic activity, and thus necessitate that you constantly monitor what is going on globally and the impact that it has on the domestic economy, and then take an appropriate policy stance based on that. And Fundi will deal with the other one. And you say that domestically we say that inflation is well contained. That is the now. That is the now. Yesterday's inflation is exactly that. It is yesterday's inflation. It is a result of previous developments and previous policy actions. What determines what policy stance you take is what the outlook for inflation and for growth is, and then you set policy on that. So I give you a sense that for the first quarter of this year and the next 2 quarters, we expect inflation to continue to have a 3 handle. In the fourth quarter, we expect it to have a handle with 4, but still the average for this year would be 3.6. But understand this, the next quarter, the second quarter, and the third quarter fall outside the monetary policy horizon. And the fourth quarter, you know, if you had taken a policy decision now, you might just only be beginning to feel it. And our own basis is that monetary policy action should be calibrated to deal with the outlook 4 to 6 quarters out. And that is what you are actually going to be looking at, and which is why I liked the question of Alistair, which focused on the outlook for 2026 and 2027, which Chris is going to deal with right now. Chris, over to you. You are muted. You are muted. Okay, let me deal with Fundi.
So, Kopano, your question, the governor touches on elements of it, which is, what does the up and down mean? So you will note that in the statement, with regards to the medium-term horizon, which was the period that Alistair was asking about, we're very clear that we see upside risk. Over the near term, which is what the current inflation print was signaling, we have seen the benefit of inflation moderating. Going into the third and fourth quarter, we're seeing some pricing pressures come in. So what is driving that? So what was driving inflation down is that we've had the benefit of lower fuel price inflation, so that component was coming down. Food price inflation was also moderating. That component has been coming down. We also had core inflation, which is in part, Rashad will talk about the disinflation and where it's been coming from. We've had that coming from some imported goods, so that's been coming down. Now, what one starts to see is that there are elements that are going to start to pick up. So some parts of food are starting to go up from a pricing point of view. We are also starting to see elements of the fuel price inflation potentially getting smaller. Remember the MPC, unlike the model will use the data as it is. The humans have to think about possible risks, and that's what we are highlighting too. There are possible risks that might not have fully materialized. So if you look at where Eskom is now using more diesel. We've heard from NERSA, which will give us the actual, but as the diesel usage increases, you should know that at some point Eskom will go to NERSA and try and recoup that because they are using more diesel at the moment. So those are the elements that come into the up and the down. There are also some currency and risk premium issues that the MPC would have had to reflect on. What is different for this MPC is by the time we get to March, we would have had a tabled budget, we would have had certain things filtering through, but this budget just came through. And it comes through with a fiscal profile, which does have some impact, which might have elements that will filter into country risk elements. So this is what the MPC has to take into account, and hence this phrasing. So we try to highlight that they're both the upside and the downside. They are in the near term, but may filter through to next year too. But that's what the inflation profile is telling us. Thanks.
Chris.
Well, we can try again. Can you hear me?
Yes.
Okay, great. That's an improvement. Look, Alistair, your question about confidence of out a year. Look, the bottom line is that one's confidence cannot be very high because we live in a very volatile world. The numbers that we have are forecasted based on a range of assumptions, including long-term oil prices, what we think the global economy's GDP is going to do, what global inflation is going to do. But as you know, these things tend to be upset by a ongoing series of shocks, which then adjust your short term and then adjust the near term part of the forecast and then carries through into the longer term. So, if we believe that the assumptions we've made are sound ones, which we obviously do, we think that these numbers, we should have lots of confidence in them, but we just know that we live in a world where there will be lots of shocks. Just to give a couple of examples, obviously oil prices matter a lot to the forecast and they move around on a 6 month by 6 month basis quite substantially. Things like food prices, we've seen very large gyrations due to a wide variety of shocks. So one always has to take the longer term forecasts with some sense that they will move. But given where we are now, these look like pretty safe numbers. Thank you.
Thank you very much. The question on China's imports, deflation, how does that affect South Africa? There are a few parts to that. The first is just to say that when we look at deflation in a country like China, obviously there are two channels to which we would think about how it would impact us. The one is, how does that impact China's monetary policy? Now, it turns out that that our financial markets are kind of less sensitive, perhaps, than, say, Chinese monetary policy to, say, US policy. So the one channel is, what does deflation or inflation in a particular country mean for their own monetary policy decision making, and how does that impact, how do those spillovers impact on the way we think about it? But I guess in this particular case, the real issue is that when we look at the inflation outlook, one of the most important determinants of the inflation outlook is the effect to which import prices provide, either kind of a downside or upside risk to our forecast. It turns out that if Chinese deflation means that Chinese import prices are low, that is obviously very good for us. It kind of depends, what are we importing? Is Chinese deflation Chinese consumer goods that are not exported to South Africa or not? There may be the odd capital goods that we import from China that may not experience the same deflation. So deflation of low prices in other countries like China, which we import a lot of goods, can make a big difference. One of the reasons why the pass-through from a depreciated exchange rate to inflation was low, at least during the great financial crisis, had to do with the fact that when your exchange rate depreciated, at the same time that import prices went in a downward direction, that almost acted as a soft landing, and pass-through was lower than what we expect. At the moment, import prices are not that dramatically rising. There's slow rise in import prices, and we will observe. China is an important contributor to our imports, and as long as Chinese prices remain subdued, that does contribute. But we don't only import from China, we import from other countries too. Thank you.
Okay, that dealt with all those questions. Any other questions? Next to Alistair.
Thank you. Good afternoon, Governor. My name is Ntando Tsukwana from Bloomberg News. Just to follow up on the comments about the budget and the fiscal impact, how do you view the outlook for South Africa's risk premium, given that in the budget that was proposed last week, the debt to GDP is seen rising again? Thank you.
Is that it? Yes. Your name again, ma'am?
Tando.
Tando.
One question online, Governor. Atol Dlamini at Alliance News. The QPM model forecast rate at 7.25. Is it correct to assume that you expect at least one rate cut this year?
Okay.
The inflation has consistently undershot both your forecasts and also economists' forecasts. And one thing that economists were saying going into today was that there was a chance of a rate cut because inflation has undershot forecasts. Have you looked into why inflation keeps undershooting your forecasts? And are there any implications of that for will you recalibrate your forecasts, or do you think that was a temporary phenomenon? Thanks.
Okay. Mampo, do you feel risky? Can I give you the risk premium question? So you prepare yourself for that one. Mr. Dlamini, you say that can we expect a rate cut? Well, as we said, the rate path from the quarterly projection model remains just that. The MPC must make its assessment and make a decision. And so we do not just follow the model. It remains a broad policy guide, and from meeting to meeting, we assess the balance of risks and we calibrate policy appropriately. There's a beauty about the model that it gives us a forecast, it gives us a path, but the model is incapable of assessing risks. You need human beings to assess those risks, and that is why you have a committee, and we do not outsource this to the market. Mampo, risk premium.
Thanks, Governor. The risk premium in our model does worsen a bit because of the fiscal targets, but it incorporates other things as well. So we're looking at a marginal change from what we had it before. I think what we're looking at is the risks that have been specified, and more so the process of approval of the budget. And once that has been concluded, then we will know certainly what goes into the budget. So for now, it's a marginal deterioration in our risk premium.
So, put simply, the calculation that we have of the risk is based on the budget as is. We do not try and anticipate what changes they would be. We take the tabled budget as is, and then we work on that basis. There might be changes, and if there are changes, we will just reconsider our assumptions and then make a decision appropriately. The beauty of being in the Reserve Bank is that you can change your forecast every 6 weeks. The poor fellows at the Treasury only have two chances, the budget and the MTBPS. So we are at a slight advantage. Alex, inflation undershooting, that happens. The key driver, remember, in the inflation undershooting had been the oil price. You have seen what had happened with fuel price inflation, and we try to incorporate those developments that over the forecast horizon we have brought down our oil price assumptions by on average $2 per barrel, and that is what we do. But in addition to that, in the MPR, we do the monetary policy review. When the monetary policy review, we alternate this. In one of the monetary policy reviews, we will assess the performance of our forecast for growth, and in the other MPR, we will assess the performance of our forecast on inflation. And then, as it is done statistically, we will then calculate what errors we see or the deviations of the actual growth or inflation forecast relative to what the print was. And so that becomes important. And so far, we have actually done well. There hasn't been anything that indicated that there is an upward bias of our forecast or a downward bias of our forecast. We could miss the thing in either one of the directions. And that is a very important thing. And what you are going to see with the current uncertain environment, and I know your colleague Kopano said that there is certainty on inflation. The only certainty we have on inflation is the previous one. We do not have certainty about what is going to happen in the future. And that is why you saw that, like most central banks now, we presented scenarios to say that there are these scenarios, and if this scenario plays out, this is how we think it will impact on inflation and growth. And if this one plays out, this is how we think it would impact on growth and inflation. Those scenarios are just there to help us, but also to help the analyst community and any users of our information to say that we did think about these things, but we just couldn't incorporate them into our forecast because we do not know which way they would play. And in our assessment of our forecast compared to the actual outcomes, we also compare it to the other forecasters, whether it is your house that does the median forecast of the analysts, or it is the guys behind you, or it is any of the big international forecasters like the IMF or the OECD. We are transparent about that, and you will find those captured in the MPR. And so you can rest assured we do watch these things. I see no other hands. I do not see anything online. And at this stage, then I must thank you very much for your participation in this press conference. We'll see you at the MPF on the 15th of April. So we will see you then. And if you, and Alex, then you will get to see, you will have your question answered in the detail. Otherwise, we're looking forward to seeing you in May. Thank you very much, and that concludes the proceedings.